Welcome to Mad Money. Or welcome to America. I'm Bill, make friends. I'm just trying to make you a little money. My job, not just to entertain, but to educate you, teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. There is a titanic battle going on in this market that you may not be aware of. It barely gets any attention. Call it the war between the individual investor and the institutional investor. I think it actually might hold the key to where this market's going, even if it isn't today. Dow declined 166 points. S&P dipped 0.07%. NASDAQ inched up 0.03%. Lots of people have been wondering how the heck this market can keep going up in response to a wave of horrendously negative news involving tariffs and trade, as well as an obvious slowdown in demand for all sorts of goods and services. They think the market's irrational because it should be going down, not up. And it never should have been able to recover so swiftly after the tsunami of selling that hit us after Liberation Day. It should have been a bear market. But it's not like people aren't selling at all. Bank of America's research department puts out this amazing report entitled Equity Client Flow Trends. It gives you a snapshot of what's going on with different kinds of investors within their organization, the institutions, the companies themselves in the form of buybacks, the private clients, that's the individuals that I think are in there buying. Under the title, Big Equity Outflows Led by Institutions and Hedge Funds, this piece of research says that we had just had the biggest week of selling in almost a year. Yep, the S&P's up 1.7%, hitting new all-time highs. And what's going on? The sixth largest outflows week in history, meaning since B of A started keeping this data in 2008. I got to tell you, that's incredible, people. According to the report, this selling was led by institutional clients, the big guys. In fact, the institutions have been net sellers in 8 of the last 9 weeks. Meanwhile, corporate client buybacks slowed to the lowest weekly level since October 2023. No hope there. So why did the market go up instead of down during this period? The private clients. That's why. The individual investors. You! The private clients bought as the market went higher. They have been net buyers in 28 of the last 30 weeks. No bear market there. The individual investor has not lost faith. Buy. They've practically propelled us the whole way from the post-Liberation Day lows. They want to own stocks. Period. Now, this is just one survey, but Bank of America is probably the best cross-section of people to examine. It confirms something that I've come to believe, something I'm planning to talk about when we hold our annual Investing Club meeting on Friday. The individual investor believes in the stock market as a way of making money. She thinks that stocks represent great, real long-term value. She doesn't want to flit in and out like the institutions. She wants to use the stock market as a way to save. Right now, I even say that the individual investor believes in Trump. Or at the very least, she's not afraid that the Trump administration will somehow blow up the economy. Now, that's a very different attitude from the big institutional investors who've been selling. And I think it's only going to get more pronounced, greater gulf coming. In the One Big Beautiful Bill Act that just passed, there's a little talked about provision. Trump accounts a $1,000 benefit for newborns. Newborns, it's automatically created. You don't have to do anything. The funds go to a diversified stock index. Every child born in the United States between January 1st, 2025 and December 31st, 2028 is eligible if one parent has valid work-eligible Social Security number. Parents can add up to $5,000 per year to the fund, and it's worth it because these accounts are tax-deferred, no taxes to withdrawal. You want to take advantage of that? Now, I'm not saying this amount of money can move the stock market. It can't. But look, individual investors made a fortune buying into the incredible comeback after the Liberation Day meltdown. It seems to me that these individuals have faith in the future. And again, they're not worried that the Trump trade policy will wreck the economy. After this run, it almost seems kind of self-fulfilling, doesn't it? If the market could mount such a comeback after a very difficult moment, which was Liberation Day, and against all these institutions, then why not keep buying? It's working. Okay, so now you can quibble over what these people are buying. There's a lot of money going into the high-flying stocks like Palantir, and I told you 50 goes to 100, 100 goes to 200 Palantir. The nuclear power stocks, and anything that's tied to Bitcoin at all. I've been adamant that there's way too much speculation. I've been wary because we are very overbought, including tonight. But the gains have been widespread, and they appear to be indicative of broader index buying. Again, positive. And the buying strong enough to offset selling from the so-called institutional smart money. It's difficult to speculate without being too political. I do think that the previous president was not perceived as pro-stock or pro-capital, while President Trump is being seen as very pro-business, except for that 1 week after Liberation Day. I've always found that Biden observation a little odd because stocks did great under Biden. But this is about perception, not performance. So let's step back from the political world for a second and just address the commitment that individual investors have made to the stock market versus institutions, because that's what really matters. The institutional outflows are indicative of a belief that there's a whole lot going wrong. You have to presume that these money managers saw the big, beautiful budget bill as inflationary. They probably hated the name, too, because it seems so silly. They think it added trillions to the budget deficit. These guys are serious guys, okay? The national debt just blew it up. Meanwhile, the president seems erratic. That Liberation Day was a fiasco to them. And Trump is so inconsistent that it makes owning stocks too risky. If tariff numbers are going to change every day, they seem like, hey, let's put some tariffs on copper. And the president's going to bomb Iran while trashing the Fed chief, calling him too late, and badmouthing him as a crybaby, as he did today. Well, these institutional investors think it's nuts to bank on the stock market. It's just too chaotic for them. But the individual investors don't seem to care about any of that. The individual is consistent. Rather than trading in and out of stocks, they're using the market as a way to save, to get wealthy. Bonds don't have much attraction to them. You can't get wealthy with them. Cash is obviously regarded as a loser. So they keep investing money in the market regardless of what's happening. So is that stupid? I contend that the stupid ones are the institutions. Why? They're too cynical, too concerned with the near term, with getting out ahead of the big one, perhaps not realizing we just had the big one after Liberation Day. The things they seem to care about, whether the Fed will cut 1 time or 2 time or 3 time or 4 time or no time, that's all inside baseball to the individual investor. The worries about the Fed versus the president and the tradition of the Federal Reserve's independence are crucial to the people who run the big money, but I think the stuff most goes right over the heads of the individual investors. Those silly press conferences that the Fed chairman has when he should be devoting more time to policy, I'm sure institutions trade throughout the darn thing. The individuals, they don't even know the pressures exist. They just want to buy shares of Netflix. They want to own some NVIDIA. They think it's interesting to buy some Robinhood. They like what Zuckerberg's doing, so they're going to buy some Meta. Look, there's nothing wrong with the short-term trading the institutions are doing, but let me give you the bottom line. When I first walked down Wall Street, the actual street right there, the Dow Jones Industrial Average stood at about 1,000. Now it's 44,000. Perhaps the weight of evidence says you should just keep buying and just stick with it. It's been right for decades. Why should the individuals stop now? Robert in New York. Robert.
Jim, thank you so much for making me money as usual. And
I'm liking that, partner.
Money with you. I've made so much money with you, Jim. It's incredible, okay? And I have a stock that I put some money into it, and I want to talk about this stock in the energy sector, which I'm not crazy about the energy sector, okay?
All right.
But this stock has a great dividend, and you've always taught me dividends are good, right?
You betcha, Robert.
Well, anyway, so here's the deal, Jim. They've been increasing the dividend for 38 consecutive years, and it's appealing for investors seeking a reliable source of passive income because of the dividend. Now, the stock has been kind of stale lately, but here's where it gets interesting. The CEO, Mike Wirtz's strategy may pay off big time on the acquisition of Hess, which gains them access, Jim, to 30% interest.
Robert, you are totally right. I've got to tell you, they get that Hess deal closed, and you must own the stock. You know, Jeff and I have been talking to Jeff Morris, trying to figure out the energy sector. I think you're on to something. Chevron will be a winner. Mike is a winner. I like your call. And thank you for saying those nice things about making money. That was terrific. Let's go to Jim in Kentucky. Jim.
Booyah, Jim.
Booyah, Jim. What's up?
Thank you for everything you do for us home investors. I really appreciate everything. What do you think is Crocs a buy, sell, or a hold?
You know what? I'm going to say something you never hear me say. Crocs and Deckers. I'm giving you two. It's a twofer. Crocs and Deckers. Too hard. You know what? There's no sin in saying it's too hard. If you like, you know, we were DraftKings and we're saying, look, the Eagles-Commanders game, that's too hard. No one would say, no, you come on, you have to have an answer. I think that's how you have to look at it. Too hard. Too hard. Let's go. And of course, I think the Eagles are going to win, but that's too hard still. Let's go to Dennis in Ohio. Dennis.
Hey, good evening. Hey,
good evening, Dennis.
How you doing?
I'm doing all right. How about you?
Hey, I woke up, so it's a good
I'm thinking
day
of barbecuing tonight. You know, it's so hot, but I'm going to throw a steak on or something, you know?
There you go. Sounds good. Hey,
thank you.
The reason I'm calling is I have a large position in Sunoco, not going to trade or anything, but I'm just curious why it's so volatile. It goes up and down like crazy.
This thing's been up and down like crazy since it came public. It is ridiculous. And then they spun it off. They do the LP. It doesn't have a good float. That's the problem. There's just not enough stock out there, and I wish they could somehow issue more stock. But remember, it's 6.8% yield, and from what I can tell, that's money good. All right, listen, everybody. At least as long as I've been around, which is kind of a while here, it's been evident that over time the market goes higher. So who are we to quibble with that? Or do we have to trade in and out and in and out and in and out and miss all the big gains? Made money tonight. Take a stock like Carvana doubling in the last few months. How do you size up a high flyer like this one? I'm breaking it down. Then who doesn't like a stock story with a side of Ryan Reynolds? I'm sizing up this recent IPO mountain. And I'm going to give you my take on it. And don't forget Flex, the artist formerly known as Flextronics, has ridden the contract manufacturing bull market this year. Doesn't have more room to run? Don't miss my exclusive with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.